my name is Gordon, and I'm going to be taking you for FAC2601. I am a qualified chartered accountant. Currently I'm working with Deloitte as the finance business partner, and I've worked with Standard Bank for about 5 years in corporate investment banking. I have been lecturing financial accounting and management accounting since 2014 on a part-time basis at Varsity College and also for UNISA and also for University of Johannesburg as well, and also at work and also at the honors level for people who had SEMA and they were trying to convert into the CASA. Yes, so I'm going to be taking you for FAC2601. It's an interesting model, and I'm hoping that we all going to be supportive. I'm going to facilitate this. Good. Yes, so we're going to start from the beginning to the end. FAC2601. I'm starting with an introduction to preparation of financial statements. We're going to be talking about a company. Why do we have a company? What is the objective of a company? We will discuss the annual financial statements, and we'll discuss about dividends. We'll discuss about shares and share issue. And yeah, so it's going to be a bit theoretical, but I think that we're going to be asking ourselves questions, and I'll ask questions and I expect you to give me an answer. I also you also are allowed to ask me questions at any point in time, and I will also be able to give you the answer. So I want this session to be very interactive. I want it to be very interactive. Most of the things we'll discuss today, we've actually done it before in Financial Accounting 1. So it is a lot of them is going to be, we're going to go into more detail, but a lot of them are going to be something that you know already, something that you've actually touched on when you were doing Financial Accounting 1. So yeah, but we're going to go a bit deeper to try to understand what it is that why are things done this way. It's very important that when it comes to accounting that you actually get to understand the principle behind it. It's not a matter of just, oh, I know how this is done, I just do it, I just know the mechanics. No, you must understand why. Why am I doing this? Why is this important? Why? The why is so important. When you have the why of everything, you tend not to forget. You always remember. All right. So we will start off by the introduction to company financial statement. Like I said, it's going to be very interactive. I'll do a bit of introduction, then we'll talk about International Financial Reporting Standard. What is an International Financial Reporting Standard? When we talk of IFRS, what do we really mean? What is International Financial Reporting Standard? Then we talk about annual financial statement. What are annual financial statement? Why do we prepare financial statement? We prepare it for who? Who needs it? What do they need it for? What sort of analysis or what sort of information can you get from the financial statements? We'll talk a bit about governance of companies, the Companies Act, how companies are being governed. Then we'll talk about share transaction. The share capital in the statement of financial position of a company is very important. It's always such a big amount. What goes in there? What is it? What is it made up of? Share capital structures. We talk about share capital structures. We talk about preference shares. We talk about ordinary shares. There are types of preference shares, cumulative preference shares, redeemable preference shares. We will discuss all of that. They are all important. They are all building stones for you to be able to prepare financial statements. So today is just the introduction to financial statement. Okay. Issue of capitalization shares. What are capitalization shares, and when it's issued, what are the journal entries that we should pass in our books? What is a right issue? What are options? What is a dividend? And yeah, so these are the things that we're going to be discussing today in our interactive lecture today. There are some key concepts that will come up. So the key concepts are as a company. Then we have International Financial Reporting Standards, IFRS. Then we have a GRAP. What is a GRAP? generally recognized accounting principles. What is it? Annual financial statement. What are they? Public interest score. What is a PIS? What is a public interest score? What do we use it for? What are the advantages and disadvantages? Then we have, in companies, we have something we call special and ordinary resolution. What are they? What is a special resolution? What is an ordinary resolution? You also, those are some of the key terms in this particular model. Rights issue, dividends, then financial assistance. When someone is talking about financial assistance, what do you understand by financial assistance? Then preference shares and cumulative preference shares and redeemable preference shares. So these are some of the key concepts that we will. At the end of this session, I expect you to be able to know and to understand the background of companies and the Companies Act, the background, all of them, and also IFRS, what is International Financial Reporting Standard. Know the types of companies that are there. What are the various companies that we have, in South Africa? I expect you to be able to know that. Then I also expect you to be able to, after this mode, name the users of the annual financial statements and what their uses are. For instance, if you name a user of the annual financial statement, what do they use the financial statement for? Why is it important that those people need when they get a financial statement? What do they look for? Why is financial statement so important for that particular user? Then we'll be able to, at the end of this session, I expect you to be able to know how to record the accounting entries applicable to the issue of shares, and then to record the issue of capitalization shares. So if by the end of this lecture you're able to know all this or have an idea, then you have learned and my mission is accomplished. Then that is all that I want you to know. Good. So we'll start off by saying, what are the components of a financial statement? What are the components of a financial statement? When you look at a financial statement, first of all, maybe even let me go take a step back. What is a financial statement in the first place?
It's a reflection of what your business is doing, performance-wise, income and expenditures of the business.
Good, excellent. It's a reflection of what your business is doing, right? Your income, your and your expenses. That is very good. That is excellent. Any other person? What is a financial statement? Okay. Any person, anyone. There's nothing like a wrong or a stupid answer. When you talk of financial statement, what do you understand, or what does it do? What does it represent for you? When people talk of financial statement, what are they? Someone has rightly said that it represents it represents your company, how well you've done. Basically your expenses and your income. Excellent. So that talks about your statement of profit and loss and other comprehensive income, right? What other meaning or definition can you give to a financial statement? When I talk of course, in this module, we are learning how to prepare financial statements. Everything we are doing in this module is to be able to prepare financial statement as an accountant. Actually, everything you do in financial accounting it's geared towards preparing financial statements. But what are they? Is it only showing us the financial performance and the income and the expenses of the company? Or does it give us other meaning as well? Yes? Someone wants to try. Becky wants to try?
It shows the financial position of the company.
Good. Excellent. It shows the financial position of the company. When you talk of financial position of the company, what do we mean? When someone says the financial position of a company, what do we mean by that? What do we mean by the financial position? Yes?
I think from what I remember, it's a static picture, the financial positions of the assets and the liabilities.
Good, excellent. That is it. So the financial statement. So far we've got two perfect definition of a financial statement. One is showing us our income and our expenses. The other is saying Becky is saying that it gives us the state of affair, or the financial position of our company, showing us the assets and the liabilities that we have. These are all very, very good answers. And so basically what a financial annual financial statement does is that annual financial statement helps us to know the state of affairs of our business. We are conducting a business, or we are in a business, we have been employed for a business, the company that we are in, right? It is performing or it is undergoing business. And when it goes business, we're supposed to know at any point in time how it has performed. Therefore, we look at the performance. So we look at the statement of profit and loss and other comprehensive income to give us an indication of within this year, 2023, how have we performed? What is our income? What is our expenses? To give us what? Our net profit. So that is what the statement of profit and loss and other comprehensive income does. It gives an indication of all our income and all our expenses to tell us, and you know that the income less the expense, it gives us what? Our profit. So the statement of profit and loss and other comprehensive income gives us what our net profit for the year has been. So for the statement of profit and loss and other comprehensive income, it only shows us how we have performed for a specific year. How we have performed for a specific year. Only 1 year. That is what the statement profit and loss and other comprehensive income, that is what it shows us. On the other hand, what is to be called the balance sheet, or the financial statement of financial position, gives us that at any point in time, how much asset do we have? How much liabilities do we have? These are very, very important. When you are conducting business, you need two things, right? You need an asset to be able to have business. How will you acquire the assets? You acquire the asset by in two ways: either your own money, or you go and borrow from the bank. So when you go and borrow from the bank, you're supposed to record what? The liability. So that is why the statement of financial position should show us how much liability we have. How much do we owe the bank? How much do we owe the lenders, those who earn us the money for us to be able to acquire the assets that we have? So the statement of financial position shows us our asset, which is very, very important, because whenever you take a company, the assets less the liabilities gives us the owner's equity.
Sorry, Apia.
Yes.
I don't see the presentation here.
Oh, you don't see that? Oh, sorry about that.
Yes.
I was actually just talking about the components of the financial statements. Okay, it's fine. All right, good. Yeah, so so that is what the statement of financial position it tells us. It's, the accounting equation says assets less liabilities gives me owner's equity. That is what is called the accounting equation. If I sell all my assets of the company and I settle all my liabilities, whatever I have left is my owner's equity. So when I look at the statement of financial position, when I look at all my assets and I deduct all my liabilities, whatever is left, the owner's equity amount tells me how much my company is worth. How much my company is worth. If anybody wants to come and buy my company, they will look at what the owner's equity is. The owner's equity is basically how much your company is worth, because assets less my liability equals owner's equity. The amount of owner's equity is how much is the value of my company. So that is why the statement of financial position is very important for me to know how much assets do I have. If I'm to liquidate my company, how much assets can I be able to sell to realize assets? That's why I need to total all my assets. Then my liabilities. I need to, because liabilities are not things I'm liable for. I need to settle these liabilities. So if I sell all my assets for cash and I settle all my liabilities, how much do I have? That is my owner's equity. And that is actually what the value of the company. So that is why the statement of financial position is very important for me to know how much assets I have, how much liability I have. If I subtract the liability from the assets, how much my company is worth. And the income the income statement, or what is now called the statement of profit and loss and other comprehensive income, it shows me all my income. It shows me all my expenses, and it gives me what? A net profit. It gives me a net profit to tell me whether have I made a profit or have I made a loss. Why is it important that I must know whether I've made a profit or a loss? Why is it important to me, or as a company owner? Why is it important that I must know whether I've made a profit or a loss? What do you think? Anybody?
I think it is to know whether the company is still a going concern.
Excellent. Excellent. I need to know whether my company is still going to be in operation in the next year or 2 or 3. I need to know. So if I made a loss, then I can do something about it, right? If I check all my liabilities, my income, and I look at my expenses and I get a loss, then I'm saying, no, my business is not doing well. I must do something. Maybe I must buy more stock. Maybe I must go and borrow more so that I'll be able to buy more inventory. Maybe I must sell much faster. So it gives me an indication of what I must do in order to be profitable. So that is the purpose of your statement of profit and loss and other comprehensive income, to show me, is my business a going concern? Am I doing well? Am I doing bad? If I'm doing bad, what do I need to do in order to make sure that I'm making profits? That is very, very important. Good. So now we've talked about 2 components of the financial statement. We've talked about the profit and loss and other comprehensive income. We've spoken about the financial position. Which other component is there? Which other components is there in the financial statement? When we talk of financial statement, it comprises what? Statement of profit and loss, the financial position, and what else? What else does the financial statement consist of? Anyone want to guess? Yes?
Cash flow statement.
Cash flow statement, good. It also consists of cash flow statement. Why is it important that I must have a cash flow statement? Why is cash flow so important? And therefore, it must form part of my financial statement. Why is it important? Any brave ones want to try? Why is it important? Cash flow statement. Why is it important?
Hi. Cash flow statement is important because we need to know how much operational cash we have in order to pay our suppliers and our creditors, and in order to operate in the business. Because if we don't have cash, then how are we going to operate?
Good. That is all that I'm looking for. Excellent. I can't add anything further. So we need to know that we have. But then why couldn't I use the statement of the profit and loss statement to tell me how much money I have? Because it tells me the net profit. So why can't I use that? Why do I need a cash flow statement to tell me?
Gordon?
Yes?
Gordon?
Yes?
There's also on the chart who indicated that when cash flow statement indicates live transaction instead of accrual.
Oh, okay. Oh, sorry about that. Sorry, I did not see the charts. Thanks. Okay, let me see. Yeah. Okay, yeah. Financially used to record transaction, but background is noise. It can. Oh, okay. Cash flow indicate live transaction instead of accrual. Excellent, guys. Excellent. So sometimes I just flip through the presentation and the in Teams just for me to see what people have written as well. Good. Financial data used to record transaction. Good. My background is noisy. Indicate live transaction instead of accrual. Good. So this one, Andrew, excellent. So Andrew is saying that the incomes, the statement of profit and loss is an accrual basis of accounting, but the statement of cash flow statement tells me how or what cash I have paid and what cash I have received. You know, so there's a difference between what the statement of profit and loss and the cash flows. The cash flow statement is telling me that have I paid, have I received. So it's only talking about cash. While the statement of profit and loss and other comprehensive income actually tells me, or I record that based on what, on the accrual basis of accounting. So what that means is that the accrual basis of accounting says that the effects of transactions should be recognized when they happen and not when cash is paid or when cash is received. While the cash flow statement is saying that no, I must only record cash when cash has been received or cash has been paid. You see, so there is a difference between the accrual base of accounting and the cash base of accounting. Cash base of accounting, we only record cash in and cash out. And that is very good because it tells me at any point in time, it tells me how much cash I have, what I've paid, what I have received, how much is left. It talks about cash, which is very important. While the accrual basis of accounting, sometimes there are other things that comes into play that are not cash. Like if I record depreciation, for example, depreciation is not cash. You know, meanwhile, the depreciation is part of expense, but it's not cash. It's an expense. Things that I have incurred that I'm only going to pay later, I need to record it as an expense. But in the cash flow statement, I don't do that. So the cash flow statement is actually what? It's the live transaction. Cash in, cash out. At any point in time, I know what my cash balance is. Whilst on the accrual basis of accounting, if I record certain things that are not cash, like depreciation, like gain or loss on sale of an asset, unrealized gains, unrealized losses, foreign exchange transaction gains and losses, all these things are not cash. Depreciation, all these things are not cash items, but we record them as expenses. So it means that if I use only my statement of profit and loss, I may not be able to determine exactly how much cash I have. It can only tell me how much profit I've made, but profit is not cash. We all understand that, right? Profit is not the same as cash. So I need a statement that must show me cash. Cash in, cash out. So that is the reason why I need to prepare the cash flow statement. Because the income statement or the statement of profit and loss and other comprehensive income does not show me cash. It shows me certain accruals and other things. Some of them are cash, some of them are not cash. But in the statement of cash flow, it tells me only cash. Good. Does anyone understand? Does everyone understand? Any question on that? I'm taking my time to explain this. All other things are not as important as this one. The rest of the slide we can cruise through it, but this is the crux of the whole thing. So we've spoken about statement of profit and loss and other comprehensive income. We've spoken about financial position. We've spoken about cash flows. What other component of the financial statement do we have? What other components do we have? We have 3 so far. 3 down. How many more to go? Okay. Then we have what? The statement of changes in equity. Statement of changes in equity. So the statement of changes in equity just tells me what the transaction that has happened between the owners of the company and the company itself. So if the owners of the company brings in cash, I need to record it in my statement of changes in equity. If they take out, if I pay dividends to the shareholders, I need to record it in the statement of changes in equity. So the transaction between owners, which are the shareholders, and the company in the form of the owners putting in cash or the company paying out dividends, those sort of transactions have to be recorded in the statement of changes in equity. Does everyone understand that? And then the last one we have is, who can tell us? The last component of the financial statement we have is, Becky?
I think it's the notes.
It's the notes, yes. The notes to the financial statements. So sometimes, so what happens is the notes to the financial statement. So the financial statement, we want to keep it very simple and we don't want it to be complicated, right? But then there are certain items that we want to be able to give more detail as to what it consists of. For instance, we look at account receivable. We say account receivable is 20,000. But this account receivable may be made up of a number of items that is making up the account receivable, right? So we don't want to show all those items on the face of the statement of financial position. So we do it in the notes. So when you go to the notes of the financial statement, it gives you more detail as to what the items in the financial statement consist of. It gives you more things. For example, property, plants, and equipment. When I go to the notes, then it tells me what the property, plants, and equipment consist of. Is it made up of investment properties? Is it made up of land and buildings? If it's made up of land and building, when was the land and building acquired? At what rate am I depreciating the land and building? So all those other information that helps you to actually to know more about the kind of property, plants, and equipment that you have. Those details have to be in the notes to the financial statements, right? So the components of the financial statement are the statement of financial position, the statement of profit and statement of financial position giving us what at any point in time, how much assets, how much liabilities, and then the resulting value of the company. Then the statement of profit and loss and other comprehensive income showing us our income and our expenses, telling us what our net profit. Then the cash flow statement showing us what cash went in, what cash did I pay, what cash did I receive, and what is my cash balance. So that cash balance in the statement of cash flow should tie up to the cash balance in your statement of financial position. Then I look at the statement of changes in equity, transactions that have happened between the shareholders and the company. Dividends, dividend payments, injection of cash by the shareholders, issue of shares. All these things are transactions between the company and the shareholders. Then the thirdly is the notes to the financial statements. Notes to the financial statements. So when you see a financial statement, that's all that it consists of. That is all that it consists of. Then what is IFRS? What is IFRS? What is IFRS? IFRS stands for, okay, yeah, maybe I shouldn't even say. What is IFRS? You hear the term IFRS. IFRS. What is IFRS? What is IFRS?
It's the reporting standards that are used internationally.
Good. That is what it is. There's reporting standards that are used internationally. What does IFRS stand for? IFRS. What does it stand for? What does it stand for? IFRS. IFRS. What is the full meaning of IFRS?
I think it's International Financial Reporting Standard.
Good. That's what it is. So IFRS stands for International Financial Reporting Standard. International Financial Reporting Standard. So it is the standard that every company should comply with in order to prepare what? Financial statement. It's as simple as it is. The standard that every company should comply with in order to prepare financial statements. And why do you think we need a standard to prepare financial statement? Why must there be a standard? Why must there be a standard? Do I need a standard? And if yes, why?
The standard is needed so that there's consistency in
100%. 100%. So that there is consistency. I cannot prepare my financial statement using my own whatever assumptions or my own policies. And another company also prepares their own financial statement using their own assumptions. It doesn't work. Otherwise, people will not be able to understand the financial statement. It has to be uniform. It has to be consistent. It has to be the same policy. It has to be the same assumption, so that I'll be able to compare one company to another. You know, to say this company is doing well and this company is not doing well. Because if people are preparing the financial statement using different methods, then I will not be able to compare two companies to tell me which one is doing better or which one is not performing. So I need some form of consistency. And that is why we use what is called the International Financial Reporting Standard, IFRS. So there are so many IFRS that we are going to be to cover between now and the next 3 weeks. There is a lot. We're going to cover IS2, which is inventory. You're going to do IFRS 15, which is revenue. You're going to do IFRS 16, which is leases. You're going to do IS2601, which is provision. You are going to do like PPE, if it's you're going to do a lot. And all these IFRSs help, it gives us the guidelines. So when we look at the leases, how should a lease be accounted for? If we look at a financial instrument, how should a financial instrument be accounted for? If we look at property, plants, and equipment, how should a financial property, plant, and equipment be accounted for? So every item on the statement on the financial statement, it tells the IFRS, there's an IFRS that tells us how we should go about recognizing it in the financial statements. That's what it does. So it's telling us the detail or the how, the method. So if I look at a property, plants and equipment, the IFRS, there's an IFRS that tells me exactly how I must account for it. And because it's one IFRS and all the companies are applying it, it is consistent. It's consistent. Good. So it's a set of international accounting standards stating how particular types of transactions and other events should be recognized, measured, and reported in the annual financial statement. Look at these words, how it should be recognized, it should be measured, and it should be reported. These words are not just words, they just came, they are important words. Because there's a part that you need to recognize, there's a part you need to measure, then there's a part you need to report on. And we'll look at all these things. Look at all these things. Good. Excellent, guys. And we've also spoken about the objective of IFRS. We've talked about the why is it important for us to use IFRS. We said it's transparency for users and comparable over all periods presented. It provides a suitable starting point for accounting in accordance with international financial reporting standards. It can be generated at a cost that does not exceed the benefits. So these are some of the objectives why we use as the standard to help us. But mainly, the main reason is that for consistency. For consistency. Good. And it says here that it is mandatory for all entities that have a public accountability to follow full IFRS. To follow full IFRS. To follow full IFRS. Good. Excellent, guys. Excellent. Now, to the easiest question of them all. What is a company? What is a company, and why are companies?
Well, there's Enduro on the chart. A company
Good.
is a legal entity that is created to conduct business activities.
Okay, good. A company is a legal entity that is created to conduct business activities. Excellent. Excellent. That is it. As simple as that. A legal entity that is created to conduct business activity. That is all what a company is. That's all what a company is. Excellent, guys. Excellent. Andrew, thank you so much. So it's a legal entity, right? That is created to conduct business activities. Good. Why is the company formed? Why can't I form a sole proprietorship or a partnership? Or, yeah, why must I form a company? Yeah, Andrew said to raise more funds, to raise money. Good. So a company is formed so that I'll be able to raise money in the stock exchange, right? Good, I'll explain that. What other reason? What other reason why I must have a company instead of a sole proprietorship or a partnership? So Andrew is saying to raise more funds, and Becky is also saying to raise money. Yes, they're all right. What other reason do you think? Because if it's only to raise money, Then because there are a lot of companies that will not be able to raise money on the stock exchange because not all companies are listed. So why do you think people will establish enterprise to get investors? Okay, yeah, to get investors. Yeah, it's also linked to money. Okay, yeah, to get investors. Okay, good one. To get investors. Oh yes, so KG is saying that to limit personal liability. That's what I'm looking for actually. To limit personal liability. And I'll explain all that. Guys, excellent. Guys, those who okay, good. Cool. So a company, yeah, a legal entity formed to make profit or for a certain objective. Yeah, good. Because some companies are profit companies, not for gain. But then why do we form a company? Because when you form a company, you are able to limit your liability. So what that means is that if I have a sole proprietorship, if I have my own business and it's not a company, I'm just operating my own enterprise as a sole proprietorship. If the company go bust or something happens and I'm not able to pay my creditors, right? The creditors can come for my assets. It can come for my asset and all right. So if that happens, the company or the creditors can actually come for my assets, right? My personal assets. They can come for it because I'm operating as what? A sole proprietorship. But once I form a company, the company is a legal entity on its own. It's a legal person. So the company has got rights and obligations. So when I form a company, all the assets belong to the company, all the liabilities belong to the company. So if my company is not doing well, right, you are only, the creditors can only come for the company. They can't come for my assets. They can only come for the assets of the company and not for my own personal assets. Imagine having a company and something happens and then they come and take my house. The house that I live in. It's not right because as a sole proprietorship doesn't have what? It's not a legal entity on its own. But a company is a legal entity on it. It exists on its own. It's got its own assets and liabilities. So if the company is not doing well and it is liquidated, they will look at the assets of the business and they will not be able to come and get to come and sell my own personal asset, my cars and my houses and whatever properties that I have. So that is why. So it limits your liability. So that is why KG is saying that it limits your personal liability. Good. And also, both Becky and Andrew are saying that you need a company to raise money, to raise cash. So what happens is that companies are formed, and most of them, the big ones, are listed on the stock exchange, like the Johannesburg Stock Exchange, where if they want to have more money, they can issue shares. We'll talk about it today. A company can issue shares to get more money. Right? So if I'm a company and I want to raise more money, I'll issue shares. Once I issue shares, shareholders or investors will buy my shares and give me money. So that is one of the reasons why it is good to form a company. Good. What different types of companies do we have? Oh, so sorry, I missed one thing. There's also, apart from the IFRS, there's also what is called IFRS for SMEs. IFRS for SMEs. What is that? What is International Financial Reporting Standard for SMEs? SMEs stand for small and medium enterprises. What is that? What is IFRS for SMEs? Yes.
Excuse me. I think it's a smaller version of the IFRS, for the
100%
companies, for
100%
small businesses.
That is what it is. That is what, because if you look at the IFRS, I don't know how many of you have seen the International Financial Reporting Standards. It's big. It's very onerous. It's a lot of information. So if a small company that has got a turnover of about maybe 100,000 or 20 or 200,000 is going to comply with IFRS, is too onerous. It's like the cost actually will outweigh the benefits. it's too much. It's no, you can't. So because of that, what they created, what the accounting standard board came up with what is called the International Financial Reporting Standard for small and medium enterprises. Because in this world, about 95% of all businesses is actually made up of small and medium enterprises. So you are not obliged to comply with IFRS if you don't have, or if your company is not at a certain level. And therefore, if you're a small company, you can opt to apply IFRS for small and medium enterprises, which is it's simpler. It's more simple. The things to comply with are not a lot. It is also very, very simple. You don't need a CA to be there to prepare your financial statements. No. Good. So that is what IFRS for SMEs are. So IFRS for SMEs may be used by those entities that are owner managed and has no public accountability. So this tells us that the only time that we have, or you are obliged to use IFRS is what? It's mostly for companies that are they are big to some extent, or they have what is called public accountability. In other words, they are listed, and therefore they are big, and therefore they've got people who actually they are relying on that financial statement to be able to make informed decision, and therefore they must comply with the IFRS. Good. All right. So so there's a question here. Fashion retailers. So this is question 1. Fashion retailers is an unlisted company primarily involved in the clothing retail industry. Fashion retailers intends expanding its operations and issues listed bonds on the Bond Exchange of South Africa, called the BESA. Is this going to be reported using IFRS or IFRS for SMEs?
No, it's IFRS.
Is it IFRS? Why?
Because of the size of the company, you have to be a big company in order to trade in the bond exchange.
100%. I cannot add anything further. You cannot be it's not any company that will be able to trade on the bond exchange. Besides, the mere fact that you've actually traded on the bond exchange means that what you are listed. It's a big company, and therefore you cannot apply IFRS for SMEs. You need to apply IFRS. You need to apply International Financial Reporting Standards, and not International Reporting Standard for SMEs. Good. So it looks like it's clear. So if a company is big, a company is listed, the company has got what is called a PIS score, a public interest score of a certain amount, then they are obliged to prepare financial. They are obliged to prepare financial statement using IFRS. Good. Excellent, guys. Excellent. We've spoken about a company. We've spoken about this, what a company in general is. We're talking about, okay. Now, what are the types of companies that we have? What are different types of companies? Like different types of companies we have. Good. Andrew also did say that, yeah, we use we're gonna, in that previous question, we use IFRS. What are the different types of companies? Yes.
It's a sole proprietor.
Sole proprietor is not a company. This is a company, but we have different types of companies.
We have a public company.
There's a public company. Good. What is a public company?
It's the one that is trading on the JSE.
Okay, yeah. So someone said yes. It's a public company. Is one that is being traded on the JSE. Good. What other companies do we have?
Private company.
State-owned company.
Yes, state-owned company and a private company. Good. So we have state-owned company. We have a what is a state-owned company? Gage says
it's owned by the government.
It's owned by the government or the municipalities. Yes. Yeah. It's owned by the government or the municipalities. And what is, someone also mentioned, a private company. What is a private company?
A company that is privately owned by individuals.
Privately owned by individuals. Okay.
It's not open for the public.
Sorry, it's not?
Open for the public.
It's not open for the public. So it's owned by individuals. It's not open for the public. And even I think the number of people are even, the number of shareholders are even limited. Right? Yeah, they are limited to a certain number. Yeah.
2 to 20.
2 to 20, yeah, I think so. Or maybe it used to be 50, but maybe now in the new standard, maybe it's 20. But I know that the number of shareholders are limited for a private company. Good, guys. All what you have said is exactly what I'm looking for. So these are the types of companies that we have. Let's see if someone has something on the chat. Okay, nothing. Yes, so we have, and then, but no one mentioned a non-profit company. So there are companies that are formed for public benefit. They are not for gain. They are just for a certain objective to help people. You know, like there are certain funds, like the Nelson Mandela Trust and a whole lot that are just established just to help people or to help schools or to fund schools and those things. So those companies, their main objective is not to make profit. It's just to have to bring up a public benefit or cultural or social activities and so on. Then we have the profit company. These are the state-owned company, the private companies, the personal liability companies, and then the public companies which are listed on the exchanges. Guys, excellent. You guys have all done so well. What is a PIS score? So what is a PIS score? Has anyone heard of PIS score?
Performance indicator score.
No, I'm afraid. Try again.
It's a public interest.
Yes, it is a public interest score. And what is a public interest score?
I can say any firm or any company that is listed on HSE has been gauged on some kind of a public interest score.
Yes.
So you need to have a certain score for your books to be audited.
Exactly. You cannot be more than right. The public interest score is used to determine what financial reporting framework you can use. So in discussing whether to use an IFRS or to use IFRS for SME, you need what? One of your determining factors is what is a public interest PIS or a public interest score. So if your public interest score is at a certain level, then you have to apply IFRS. If it is below a certain level, then you have to apply IFRS for SME. Right. So at this point in time, it's just important just for you to know what a PIS score does. PIS score does. And how they calculate the PIS score is that the company say 1 point for each employee or the average number of employees throughout the year. So if you are a company like maybe Standard Bank that has got 50,000 employees, already the first 0.1 already they have a public interest score of 50,000 because each employee is carrying one point. Then Standard Bank will look at 1 point per million rand of third-party liability. So if you are a company and your third-party liability is, let's say 300 million, it means that you have to add another 300 into your public interest score. So let's say you are Standard Bank and you have 50,000 employees. Already you start off with 50,000 plus, let's say Standard Bank also has 300 million liability. So 1 point for each 1 point per million rand of third-party liability. That means if you have 300 million, that means you add another 300 to your 50,000. Then 1 point for each million rand of turnover during the financial year. If the turnover is $500,000 rand, you score half point. So if your turnover at Standard Bank is, for argument's sake, is 100 million, you add another 100 to it. And then 1 point for every individual who at the end of the year is known to have a direct or indirect beneficial interest in the company. So you look at all your shareholders, those who have got a direct interest, and even those who don't have a direct, but they have indirect interest. And let's say there are 20,000 people, you also add another 20,000. You total all this, and then you get, let's say, a public interest score of maybe 75,000. Already, you must prepare your financial statement using IFRS. So I think the threshold is about I think if it's below about 3, I'm not very certain, but there's a threshold beyond which you must use IFRS for you must use IFRS, and if it's below that point, you must use IFRS for SMEs. So it's just an indication, just an indication. You're not going to be tested at this point in time on a PIS score. Okay, what is a GRAP? Has anyone heard of the word GRAP before? Now we've learned about things. We've learned about IFRS. We've learned about IFRS for SMEs. Now we have what is called a GRAP. Has anyone heard about it?
It is generally recognized accounting practice.
Excellent. Generally recognized accounting practice or accounting practice or accounting principles. Yeah, that's what it is. So that is what it is, generally recognized. So generally recognized accounting practice, also known as GRAP, is a set of fundamental concepts that serve as accounting process guidelines for South African-based companies. These guidelines laid down by the Accounting Standards Board ensure that the public sector agencies record their financial activities accurately and consistently. Yeah, so it's mainly for South African companies, and they are mainly for state-owned enterprises. So mainly for companies that comply with what the PFMA Act, the Public Finance Management Act. Right. So if you are applying the GRAP and there is a discrepancy or there is a conflict between what the GRAP is saying and what the PFMA Act is saying, then you must comply with the PFMA Act. The PFMA Act takes precedence over the generally recognized accounting practice. Yeah. So the general recognized accounting practice, yeah, it's used for government agencies or for government companies, or also to simplify their accounting reporting requirements. Good. We've already talked about state-owned entities. We know what state-owned entities are. We've talked about what is the purpose of an annual financial statement. We know what annual financial. Yeah, guys, what is the purpose of an annual financial statement? Just summarize everything we have said so far. What did we say is the purpose of an annual financial statement? What is the main purpose of an annual financial statement?
I think it's to give the users information about the performance of the company.
Exactly. It's to give information to the users about the performance of the company. That is all what a financial statement does. It's to give information to whoever cares to use it, to give information about what the financial performance of the company, the state of affairs of the company, and yeah, how the company has performed and what assets and liabilities the company has, and basically what cash we have and how the cash has been used, and that. Yeah, so users are able to make decisions on the company based on the financial statements. That is all a financial statement does. So users are supposed to be able to look at a financial statement and make decisions out of it based on what the financial statement is telling them. So we said users of the financial statement. So who are the users? What are some of the who are some of the users of the annual financial statement? Yes. Let's start by mentioning them. Who are the users? You did say right now, Becky, that the users of the financial statement need them to make decisions. Who are the users?
Shareholders.
Shareholders. Let's stop there. Shareholders. Shareholders are one of the users. What do the shareholders need a financial statement for?
To see the performance of the company.
To see the performance of the company, because if I'm a shareholder, I want to know how my company the company I've invested in, how has it performed? I want to know so that you tell me whether am I keeping my share or am I selling it, right? That is why that is why they need it. So the shareholders need it for them to see how has the company performed, and therefore based on that, they decide whether am I selling my shares in the company or am I still holding it. Which part of the financial statement would they be interested in as a shareholder? Which part?
I would say assets and liabilities, the financial position of the business.
You think so? Or you know so?
I think so.
You think so?
It's the profit.
It's a profit, right? I think it's more of the profit. It's more of the, because if I should think about it, if I'm a shareholder and I look at annual financial statement, I go to the statement of financial position, assets, liabilities. What is it gonna? Nah, I will not open that place. I want the statement of profit and loss. I want to know, is the company making a profit? Are they making a loss? That would determine whether am I selling my shares or am I keeping them? So I think for the shareholder, the profit and loss part of the statement of financial position would be more ideal. Don't you think so?
Yeah, and also the dividends.
And also the dividend. And where will you get the dividends? Which part of the financial statement? Sorry?
I think it's changes in equity.
Statement of changes in equity. Good. So these are the two places that what I will be interested in as an investor. The statement of changes in equity and the statement of profit and loss. Because I want to see the dividends, how much dividends was paid, in the statement of changes in equity, or how much has been paid so far. In fact, I'll even check, has the dividend even been paid at all? Yeah. So you see, from this dynamic, then you think, oh, okay, so this is why I need it. So this is why an investor actually needs the financial statement. This is what they are using it for. Yes, that's exactly what they are using it for. To check the statement of changes in equity, to look at the dividends, and also to look at the statement of profit and loss, to look at the profit or loss that they have made. Good. Which other shareholder do we have? Which other user? Sorry, user. Someone must give another one. Users?
Investors.
Sorry, investors we've already spoken about. Oh, shareholders or investors, yeah, they're all the same.
Creditors.
Creditors. Good, let's stop there. Creditors. Why would a creditor be interested in the financial statement?
They want to know if there's money to pay them. If they
100%. 100%. If I'm a creditor, I want to know, does the company have enough money to pay me? Does the company have enough money to pay me? So where will I go? Which part of the financial statement will be interested for me as a creditor?
It's the cash flow.
The cash flow. Good. The cash flow. I want to see the cash balance. Are they in a loss? So if I'm in a loss, then I say, I'm not even gonna sell to this company. Is it why sometimes when you are in a company and you are in the accounting department and you are determining the credit policy of a company, you look at you ask for their financial statements. Based on the financial statement, you can determine what credit policy you're going to give this customer, because based on the financial statement, you're gonna tell, oh, these guys, look, they are making losses. I think I need to make the policy to be more. I should be more strict. I should collect my money faster, than giving them credit, right? Because they might not be able to pay me, right? So that's why they request for among other things, they also request for your financial statements. Based on the financial statement, the accountant analyzes it to see whether they must give you a credit, they must extend your credit term or not. You see, good. So they look at the cash flow. What else? Yeah. Oh yeah, cash flow. Actually, yeah, cash flow. Yeah, cash flow. Okay. What are the other users of the financial statement? So now we have shareholders or investors. Then we have creditors. Who else? Who else is there? Users.
Employees.
Employees. Excellent. Why would an employee want to have a look at the financial statements? What do they want?
I think to see if there's growth in the business or not.
If there is
growth in the business or if it's dying.
Oh yeah. Of course, I want to know if I'm if I'm going for an interview in this company. I want to know their financial statement, not only so that when they ask me a question, I'll be able to answer, but I also want to know, is the company performing well? Is the company performing well? Are they growing? And I can even go further to say, do they have enough cash to pay salaries? Don't you think so? Do they have enough cash to pay salaries? Would they be able to pay me? That is also very important. So I look at your I look at so yeah, so because of that, where do I look? Which part of the financial statement do I look for an employee?
Maybe the financial position of the business or the net profit. I'm just guessing.
You are guessing. No, you mustn't guess. From how far you have come, you mustn't guess. You know, and I know you know. Let me check what people are saying. Net profit, credit.
Look at the profit and the cash flow.
You look at the profit and the cash flow. Yes, profit. You tell me, oh, the company is doing well. And then if the company is due, and also the cash flow to see whether do they have enough cash to actually to pay my salary. Very, very important. Very, very important. I think that should be all for the employee. Yeah. I also look at I look at the trend of the revenue. The revenue trend, is it increasing or decreasing? But of course, that will come through in the net profit anyway. Yeah, guys, you guys are smart. You are smart. Okay, what other users do we have? Government agencies or regulators. Excellent. Government agencies or regulators, Andrew, that is on point. Why would a government agency or regulator like SARS need a financial statement? For what? What did they need it for? What does SARS need the financial statement of my company for? SARS. Yes, they want to know whether you have the tax that you are saying you have declared is actually the correct tax, right? So SARS need your financial statements to check that you said your tax is. Remember, when you prepare the statement of profit and loss, you have profit before tax. Let's say it's 100,000. Then you have tax. The tax is 28%. What's the tax rate now? Is it 28%? Probably 28%. So that would be what? Would be 28,000. So SARS will take your financial statement and will know that, oh, your profit before tax is 100,000. Therefore, the tax I should be collecting should be what? 28,000, applying a tax rate of 28%. So if you don't pay SARS 28,000, SARS knows that you are lying. So SARS needs your financial statement to be able to know exactly how much tax you are supposed to pay. Excellent, guys. Excellent, excellent, excellent. So, which part of the financial statement is SAS interested in? SAS is interested in which part of the financial statement?
The statement of the financial position of the business. The tax on the income statement.
The tax, yes, the tax in the income statement, yeah. So they look at what your profit and loss and other comprehensive income, right?
Yes.
It's very, very important. Well, they can also look at the statement of financial position, but we're not there yet. We're taking it a step at a time. Yeah, but the main, for the purpose of this module, the main place they will look at is your statement of profit and loss and other comprehensive income. Good. Thank you, Tula Kelly. Very, very good. Which other? Now let's have just two more. Which other users are there? Just two more, then we're done with users. Auditors. I'm just trying to think. I was once an auditor. I'm just trying to think what I needed it for. Auditors. Is the auditor a user of the financial statement, or that they actually work on the financial statement? The auditors actually work on the financial statement, but they are not users of the financial statement.
True.
Yeah, because an auditor goes to the company to go and check whether what the directors have reported on the financial statement is actually correct based on the international financial reporting standards. So auditors are supposed to be an expert of international financial reporting standards. So the auditors actually help to prepare the financial statement to make sure that the financial statement are at a good standing. Yeah, they actually reporting the state of affairs of the company. So I wouldn't say they are users. Yeah. Management. Yes. Management. Yes. Company owners are the same as shareholders or investors, so they are fine. Management, yes, management needs the financial statement. Why do management need the financial statements? So when I talk about management, we're looking at like the directors and the board of directors. Why do they need it? Yeah.
I would say they're interested in the statement of profit and loss just to see the turnover of the business and the performance thereof, and probably looking at salaries and the expenses to see where they can cut off if they're overspending.
I think I will not add anything to it. You have said it all. Excellent. I will not say anything further. That's what they need it for. Someone has said something so important. The banks, powerful. Banks, man. Why would a bank need a statement of financial annual financial statement for? Why would a bank need it?
If you have any overdraft with them, they want to see your performance, how much money the business have, just in case you have an overdraft and you owe them.
Exactly. So they want to know whether you'll be able to pay them their interest. That's all they're interested in. So they want to know how much profit you are making, right? And how much cash you have. So they'll look at your cash flow and your net profit in the statement of profit and loss, whether you are making enough profit and also whether your cash is good. And all that they are interested in is that will you be able to pay their interest? And also the loan repayment. You've gone for a loan you've gone for a loan. They want to look at your cash flows statement and also your statement of profit and loss to know whether are you making enough profit or enough cash for you to be able to settle the loan. And also for the bank, they also want to know, should they give you more loans? Because if they look at your debt equity ratio and they think that you have too much debt, then they will not give you any more loan. They will say, you know what, your profit, your risk profile is too high. So the banks, they need everywhere. The banks need to see your cash flow. They need to see statement of profit and loss, and they need the statement of financial position. The statement of financial position, they want to know how much loan you have already. The statement of cash flow, they want to know how much cash you have, whether you'll be able to pay them their interest and also to settle their loan, and also the financial statement of profit and loss, whether you'll be able to, whether you are making enough profit or you are generating enough revenue to be able to be able to pay them, Guys, you guys have done so well, and so you see how important financial statements are to all these. So, and all these people are very key people in your business, and they all need your financial statement, and it tells them something. So it's very important that you prepare the financial statement, you prepare them well in accordance to international financial reporting standards, so that any user who looks at it, you'll be able to convey the right information to them. And so that is why we study accounting, to be able to report accurate numbers, which from that numbers, our users are able to make informed decisions. Any question on that before we continue? Yeah, collateral as well. Yes, any question on that, guys, before we continue? Good, no question, we continue. So these are some of the ones: owners, potential investors, management, borrowers, suppliers, creditors, tax authority, bankers, employers. Good. So now let's the Companies Act. What has the Companies Act got to do with preparing financial statements? What has the Companies Act got to do with preparing financial statements? Who can tell me? What is the link? What is the link? What concerns Companies Act to financial statement? Why? What is the link?
Maybe there's compliance that needs to be done in terms of reporting, and it's in the Companies Act, and how the notes should be stated and everything else in the financial statements.
Exactly. Remember, we are preparing the financial statement of a company. Therefore, there's no other place to go to get guidance than what? The Companies Act. The Companies Act or the company law tells us exactly what should be disclosed, what should be disclosed, how a company should be governed. So it is very, very important that, so that is the link. So if you are preparing the financial statement of a company, then therefore it means that the Companies Act is very relevant. You need to know what the Companies Act say about what? The disclosure and certain things that you must take into account when you are preparing the financial statements. Very, 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 very important when you are preparing the financial statements. Good. Who knows about authorized share capital and issue share capital? Who has heard about share capital? And what is the difference between authorized share capital and issued share capital? Anybody? Any guesses? Authorized share capital, issued share capital, what are they?
Can I try?
Please try. Please try.
Authorized share capital is the limited number of shares that you can give out, and then issued is the ones that you've already sold.
Voila, that's what it is, 100%. So basically, a company has got, remember when we were doing sole proprietorship, right? For every shareholder, there was a capital account that was open for a shareholder or the owner of the business, whereby their drawings and their or all the transaction that happens in the company between the sole proprietorship and the owner, it gets recorded. It was called a capital account, right? But for a company doesn't just have only one owner. It has several owners. Thousands of people they've bought the company shares. So the company has got millions, if not like thousands of shareholders, right? We cannot open a share account for every single shareholder. So because of that, what we do is that we give them what we sort of we divide it the shares that we are or the right for them to have a share in the company, and we call them shares, right? So when an investor buys into a company, we give them what we call a share certificate. That share certificate gives them the right to be able to partake in the dividends of the company. To partake in the dividends of the company. So that is what a share capital is. So whenever a company wants to issue or wants to get money, they issue a share capital. What that means is that they issue a share certificate to a potential investor of the company. So they take the money of the investor, and then the investor gets what? A share certificate. That share certificate gives the investor or the shareholder a right to partake in the dividends of the company. So the authorized share capital is normally when you start a company, your memorandum of incorporation tells you exactly how many shares you are authorized to issue. But you don't have to issue all the authorized shares. So let's say in your memorandum of incorporation, you decided that you have about 100,000 authorized share capital that you can issue. But at any point in time, maybe you may just have maybe issued only 80,000 of it, right? So you keep some. As and when you need more money, you then issue some. As and when you need more money, you just issue. And the more you issue, the more your share capital is getting to the maximum or to the 100,000 limit. So authorized is how much you are authorized according to your memorandum of incorporation, and then the issued is how much share capital you've actually issued to shareholders. So in the financial statement, in your statement of financial position, you actually show the authorized share capital as well as the issued share capital. I mean, you disclose them in the notes to the financial statement. Good. Any questions? Any questions? And you know that previously we used to have what is called a share premium and the stated account, and used to have a nominal share, used to have a nominal value. But the New Companies Act 71 of 2008, the shares no longer have any nominal values. So there's no par value. We used to have what is called a par value. So then there was a share premium account and then the stated capital account. Now it doesn't exist anymore. So when you open the set of financial statement and you see a share premium, it is based on the old share that they have issued some time back, maybe 15 years ago. But now going forward, any new share that you issue you can't have a share premium because there's no nominal value. Okay. So let's look at our example 1. We are about to end. Let's look at our example 1. ABC Limited issues 1,000 ordinary shares at R1.80 per share. Prepare the journal entry to account for the issue of these shares in the financial records of ABC Limited. Can I give you 3 minutes? Then we do it together. ABC Limited issues 1,000 ordinary shares at R1.80 per share. Prepare the journal entry to account for the issue of these shares in the financial records of ABC Limited. Who wants to give me the journal entry? What do I debit? What do I credit? And how much? Credit share capital 1,800. Okay, credit share capital 1,800. Debit cash. Good. Perfect, Andrew. Good. So I am issuing shares. If I issue shares to a company, it means that what? I will get cash. Because remember, I'm the issuer, I'm the company. When I issue shares to a shareholder, I take their money, right? So I debit cash because my asset has increased. So I debit cash, and what do I credit? I credit share capital of the 1.81 Rand 80 cents multiplied by 1,000, multiplied by 1,000 shares. So yeah, does everyone understand? I'm issuing shares to a shareholder. So the shareholder is going to give me money, and then I'm giving the shareholder a share certificate. Because I've got money, I'm going to record what? A debit to cash, because my cash has increased. Then I credit what? Share capital, because now I need to increase, I need to show that my share capital has increased because I've given shareholders or I've given shareholders the right to participate in the dividends of my company. Good. So let's look at the solution. Debit bank or cash 1,800 and credit share capital 1,800. Does everyone understand this? Does everyone understand this? Good stuff. Any questions? Any questions? There's nothing like a stupid question. Your question might help someone who is maybe shy to ask. Please ask. When it comes to share capital, you always multiply the number of shares multiplied by the amount that you decided to sell it for. So it's always the number of shares multiplied by the price per share. In this case, 1,000 multiplied by 1 Rand 80 gives us 1,800. The cash I've received, and I credit my share capital. Any questions? Okay. What are the types of shares that we have? What are the types of shares we have?
Ordinary shares.
Good. We have ordinary shares. What other shares do we have? Let me see if someone. Yeah, preference shares.
Preference shares.
Good, good. So like let's say preference shares. Excellent. And yeah, so basically we have ordinary shares and we have preference shares. Any other one you know? Any other share that you may have come across? Okay, good. Excellent. And good. Okay, so we have ordinary shares. We have preference shares. And under the preference shares, we have two main ones. We have cumulative preference share and redeemable preference shares. Yeah, so basically we have two main types of share, the main ones, ordinary shares and preference share. What is the difference between an ordinary share and a preference share? What is the difference between an ordinary share and preference share? What is the difference? What is the difference between ordinary share and preference share? Oh, let me check if someone has posted something. Okay, voting. Someone, Andrew just said voting rights. Explain it further. What do you mean by voting rights? Which one has voting rights? The preference shares? Okay, so voting rights, ordinary has got voting rights. Preference shares can also have voting right, depending on the terms of the preference share. But by their very name, the name of the share, can you tell me something? One is ordinary, one preference. What do you think? Someone must guess.
Ordinary shares,
yes,
in terms of dividends, they only get dividends if there's profits, whereas preference, they will always get dividends, I think, something like that. But it has to do with dividends.
Yes, Yes, it means that you do understand. So the fact that it's called preference, that means what? It's a preferred share. So when it comes to payment of dividends, we have to pay the preference shareholder first, because what is they take what do you call it? They are preferred to the ordinary share, and hence the name preference. We prefer them, or they come first, right? So they are first in line to receive the dividend first, and then before the ordinary share. And also, when a company is liquidated, the preference shareholders will receive money first, will receive whatever is left of the company. They will receive it first. Then after we settle the preference shareholders, then we will settle the ordinary shareholders. So a preference share has got more, is preferred. They receive preferential treatment as compared to an ordinary share. Based on what I've just said, which one do you think will be more expensive, ordinary share or preference share? Which one will be more expensive?
Preference shares will be
preference
expensive.
shares. Good. The preference share will be more expensive because it's got so many rights. They are preferred. They receive dividend first. When the company is liquidated, they also come first in line. So they'll be more expensive. Good. Excellent. And then these other types of preference shares we have, what are they? Cumulative preference shares and redeemable preference shares. What is a cumulative preference share?
Cumulative preference shares are those shares where even if the dividend is not declared in that year, then they'll still be owed that money regardless.
Excellent. Thank you so much. That is what they are. So cumulative, the fact that it's called cumulative means that their preference shares never, their dividends never falls away. They accumulate. So even if you don't pay them now, it doesn't mean that they are forfeited their dividends. When the company start making money or start paying a dividend, you must pay all the arrears, all the ones that you haven't paid. You must pay it. So that is a cumulative preference share. So their dividends does not fall off if you don't pay. If you don't pay, it's fine. We will accumulate it. As soon as the company start making profit, you are expected to pay. You must pay. Then what about a redeemable preference share? What is a redeemable preference share? Oh, they said my line is breaking. Is it better? Can everyone hear me? Am I breaking? You are fine. Okay, Vusi said I'm sharp. Dembani said I'm sharp. Andrew says I'm sharp. Oh, Andrew hasn't said anything. Okay, Makat Avase said I'm sharp. Okay, good. Thank you. All right. So what is a redeemable preference share? We're almost done. What is a redeemable preference share? What does the word redeemable mean? To redeem something. What does the word redeemable mean? Okay, so I'm sharp. Okay, so redeemable means that I've received. Okay, the company has issued a redeemable preference share to a holder, right? To a holder. In addition to paying the holder the dividends every year, also you need to pay them the actual amount of the you need to pay them the preference share at the end of a certain year. So it's like a company has given you a loan. Every month or every year you are paying interest, and at the end of the 5 years or 10 years, depend on the term of the agreement, you're also supposed to settle the loan. That is what a redeemable preference share does. In addition to paying the dividends every year, you're also supposed to settle the actual preference share back to the holder of the preference share. And hence the term is what? Redeemable. You are redeeming it. It's just like a loan. When a bank gives you a loan, in addition to paying interest, you are also supposed to pay them the capital at the end of the term of the loan. right? So a redeemable preference share is just like a loan. It's a liability, actually. A redeemable preference share is a liability. It's not equity like the others we have discussed. It's actually, it got the same nature as a loan. Because at the end of a certain period of 5 years or 10 years, depending on the agreement, you are supposed to, the company is supposed to pay back the preference share back to the holder. Does everyone understand this? Yeah. Andrew said it can be bought back by a company. Good, excellent. That's what it means. It can be bought back it can be bought back by a company, redeem. Yeah, but in this case, the company is actually paying back the redeemable preference or paying the loan back to the holder of the preference share. Good. There's an example here. The following balances were taken from the books of XYZ Limited on 31st of December 19.0. There was issue ordinary share of 150,000 and retained earnings of 160,000. On 1 January 19.1, the director decided to make a capitalization issue at R1 of 1 share for every 3 shares previously issued, with a minimum effect on distributable reserve. What is the journal entry that will be passed? Can you do it? Is it hard? So this is an extract of the statement of financial position of XYZ Limited at 31st of December 19.0. There was issued share capital of 150,000. The shares, yeah, R1 shares, 150,000. The shares cost R1 and the share capital is 150,000. That means there were 150,000 shares multiplied by one to get 150,000. The retained earnings was 160,000 as at 31st December 19.1. Then on the 1st of January of the following year, which is 19.1, the director decided to make a capitalization issue at R1 of 1 share for every 3 shares. So for every 3 shares that the company has, there was a capitalization issue of R1 shares. Prepare the journal entry to record the capitalization issue. The amount I'm not so sure about. Okay, Andrew said he's not so sure about the amount. Okay. Any other person? Profit or loss, Jungo said 50,000 to be issued. Okay, yeah, 50,000 to be issued. That is right, because for every 3 shares held, one share is to be issued. So 150 divided exactly 150,000 divided by 3, 50,000. Excellent. That is it. That's right. Yeah, that is right. Debit, retain earnings. Good. Excellent. Debit, retain earnings and credit. Credit issue ordinary share capital. Good. That does it. Does it. So the number of shares in issue, you have 150,000 divided by 3. Why divided by 3? Because the question said that the director decided to make a capitalization issue of R1 of 1 share for every 3 shares previously issued. So for every 3 shares that you previously have, you are going to issue 1 share. So it's what? It's 150,000 divided by 3 to give you what? 50,000 shares. 50,000 shares. The number of shares in issue, 150,000 divided by 3 is equal to 50,000 shares to be issued. The journal entry is that you debit retained earnings of 50,000 and you credit your issued ordinary share capital of 50,000. So for a capitalization, a share is not the share that you issue for cash. It is a share that you decide that you're just going to give additional shares, but it should come. It is coming from the company's retained earnings. That's why you debit the retained earnings and you credit your ordinary share your textbook talks, it's got notes about capitalization issue. I suggest that you read it just to get a more understanding of what capitalization issue is all about. Good. What is a right issue? I think this is our last topic. What is a right issue? Okay. So I don't think you have heard it before, but so a cap. So when you issue shares, there are two ways. Either you issue for cash, like you issue ordinary shareholders, and you debit bank or cash and you credit your share capital. You can also issue what? Capitalization issue. For capitalization issue, you are not going to get any cash from it. You just wanna be able to increase the share capital or the share amount to the shareholders, but you are not getting any money for it. So that is why instead of debiting cash, you debit retained earnings. So it's always, capitalization issue is always against retained earnings. You debit retained earnings and you increase your share capital, because capitalization issue means that what you are issuing shares for no cash. You are issuing shares for no. It's also called a bonus issue. Bonus issue means that you are getting no money for it. That's why you debit against retained earnings. Then we have what is called a right issue. So for a right issue, you are getting money for it, but the money that you are getting is actually less than the market value of the current shares. So let's say right now your shares are trading at 3 Rand per share. When you issue a right issue, you're going to issue the new shares at maybe 2 Rand per share. So that is what a right issue is all about. I think at this point in time, we're not going into detail to calculate. It's just for you to be able to know what is a cap issue and what is a right issue. So a cap issue is you issue with no money. You don't take any money for it. It's a bonus. It's also called a bonus issue. So therefore, the debit is against retained earnings, and you credit your ordinary share capital. A right issue, you get money, but the money that you get is less than how much your shares are trading currently. So your shares might be trading for 3 Rand, and then you might issue the share, you might issue the right issue at 2 Rand or 2 Rand 50 or something like that. Yeah, so that is the end of everything. Any questions for me? This is the overview. Today's lecture was the overview, the introduction, for you to know what to expect and what a company is and whole. It gives the foundation. Tomorrow's one, it's actually the starting of everything. Accrual base of accounting, the conceptual framework. What are the concepts that underline the preparation of financial statement? Very, very important. I suggest that you read, you do some pre-reading just to get an idea, so that when we come, you can ask questions about the things that you don't understand. I'm just going to facilitate, but we're just going to, ask questions and as we go along. Okay.